If you just pick a few stocks at random, the odds are stacked against you. You're more likely to lose than win from a few randomly chosen stocks. Some people, their takeaway is the evidence is stronger than ever that we should be passive, diversified investors. Other people look at it and say, well, we know the markets aren't perfectly efficient. We know there's at least some opportunities out there. And what this is showing us is how large the payoffs could be if you can successfully exploit your skills or be lucky, to be honest. But if you're either lucky enough or skilled enough to be able to pick the winners, the payoff to doing that's much bigger than we realized it was before.
So Hendrik, I must say your research is really making waves as your study titled Do Stocks Outperform Treasury Bills? It's been referenced several times on our podcast, and it's been a study that I think can humble many stock pickers in the audience. So you first looked at the performance of individual stocks relative to Treasury bills from 1926 through 2016, and I believe you updated that study through 2020 and 2022. So how about we just get this kicked off as what was the impetus for performing this study?
Well, in all honesty, I kind of stumbled into this line of research by accident. And the answer of how it happened is actually a little bit techie, but I was, I'm basically a data guy, a statistics guy, a finance professor who studies the markets. And I was working on a project with a couple of co-authors, and we were studying stock price performance after events like IPOs and secondary offerings and the like. And we had a pretty big sample of stocks. And for some technical reasons, we had decided in that study to look at continuously compounded returns or logarithmic returns. And I was looking at our data, our summary statistics for a pretty big sample of stocks. And I noticed that the average continuously compounded return for this pretty big sample of stocks was a negative number. And as I said, the explanation here is a little bit techie, but I was surprised. I wasn't expecting to see a negative average return for a big sample of stocks. And just another techie aspect here, I had in mind that one of the reasons people study logarithmic returns is that they add up nicely. So if an average is negative, then the sum of all of them is negative. A logarithmic return is not actually a return. You have to convert it back. But you don't change the sign when you convert it back. So it's all a little bit techie, but I'm just looking at this data, and it suddenly occurs to me, a lot of these stocks are losing money in the long run. And I wasn't expecting that. And so I thought, well, I should really start digging into this a little more systematically. So I did start digging in systematically, and that led to the paper you mentioned. I should mention, by the way, I titled that paper, Do Stocks Outperform Treasury Bills? I mean, that was basically marketing, the strategic title. My thinking is if you use that title, people have to look. They have to see, what's this guy talking about? But underlying the outcomes in that paper is skewness. Now, that's another kind of techie term. Maybe you prefer asymmetry. But the fact is, stock market returns, once we've compounded them for a while, are positively skewed. If you have positive skewness, it means the average outcome is higher than most of the individual outcomes. And that's essentially what's going on, essentially what drives this whole line of research. But, if I had labeled that original paper, stock returns are skewed, I just don't think it would have caught people's attention the same way that the actual title did. Anyway, so it is really something that I kind of stumbled into. But once I stumbled into it, I thought, wow, these results are really striking. I should circulate them. Went ahead and did that, and it's been interesting to see how much attention has been focused on it since then.
One of your comments that stuck out to me at the start of your answer was that the average return for a stock is negative, and that surprised you. For those that might not be math inclined, why did that finding surprise you?
There's a big economic body of theory and evidence about risk-return trade-offs. And stocks are one of the more risky asset classes. Maybe not the very riskiest. Maybe venture capital is more risky. Maybe some exotic markets like, say, electricity derivatives might be more risky. But stocks are among the riskier assets. So we expect a positive average return in stocks. And I should clarify, it is true that the average return, the mean, the same average you've been talking about since, sixth grade or so, the mean return on stocks is positive. It's that the return on a typical stock is not positive. So that's one of the striking things that came out in my original study. I used a database, the acronym is CRISP, Center for Research and Security Prices, is put together by the University of Chicago. It's what most academics study, and it's kind of considered the gold standard database for reliable historical stock return data. I studied this CRISP data since 1926, all the individual stocks, found that the majority of stocks lose money. I focused in the paper on comparing stocks to treasury bills because I had in mind the idea of a risk premium. We're supposed to earn a risk premium in stocks as compared to something low risk like treasury bills. What I found is that the majority of stocks, about 4 out of 7, don't beat treasury bills in terms of their compound returns. If I focused on the number that I called shareholder wealth creation, which the biggest difference between that and a compound return is it just takes the size of the investment into account. So if we want to ask a question like, well, investors, the body of investors, the group of investors in the stock market, how have they done in the long run? How much wealthier have they become? With that sort of question, it's natural to think about things in dollar terms, which then puts more weight, more importance on big stocks. In any event, when I did look at things in dollar terms in this wealth creation measure, it was even more striking. About 4% of the stocks accounted for all of the net wealth creation in the stock market U.S. stock market since 1926. So I was surprised because we usually think there's a positive risk return trade-off. And I should mention, it is there on average, but it's not there for the typical stock. Now, how can it be there in the average, even while it's not there for most stocks? Because there's a few stocks that do tremendously well that pull up the average. That's the essence of the findings.
Yeah, and if I can paint some numbers from your research, I believe one of the earlier studies that looked at 25,000 companies, and in aggregate, they created $35 trillion in net wealth creation. But if we just tune into those top performers, the top 90 account for over half of that $35 trillion. And it's the top 1,092 that is the 4% figure you've referenced there that accounted for that in aggregate $35 trillion. So I think that top 90 really stands out to me. So it's just like this tiny subset is driving so much of the performance of the broad overall market.
Those were among the results that surprised me, and I think surprised a lot of people. Not absolutely everybody, I should mention. When I first came across these results and was starting to talk to some of my academic colleagues about it, many people like me were surprised, but there was a handful of them who said, well, of course, what did you expect? Which just shows that some people had already thought carefully through these issues, even if they hadn't stopped to actually document it previously.
And you mentioned venture capital. People often think that a venture capitalist is going to go out, they'll make 100 investments, and they're very happy if 1 or 2 or 3 work out very well. People sort of perceive that as a risky activity, venture capital in general, but they're doing the same thing when they, buy a passive index fund. Just a select few is going to be driving those returns. So skewness is something that we see in many areas of investing, life, a lot of areas. And people talk a lot about power laws, and it relates to that as well.
Yes, agreed. So I think skewness is pervasive. One of the ways I've described the results of this study is I said, look, I'm going to tell you about an asset class. And in this asset class, most of the investments lose money. As a matter of fact, the single most common outcome is losing all your money. But there's a few really big winners. There's a few of these investments that really pay off handsomely, enough to make this asset class worthwhile and desirable. And if I described it that way, a lot of people would respond, yeah, we know that about venture capital. But of course, I'm talking about publicly traded common stocks over longer horizons. So what I conclude from this is that this positive skewness, it's not something that just shows up in some corners of the capital markets like venture capital. It's really pervasive. It's fundamental to investing in an entrepreneurial economy.
So if you were to try and explain why this skewness exists to such a large degree that so few companies generate the majority of the wealth in the economy and the majority of the returns for investors. How would you try and explain, why that is?
There's a couple of ways to come at it. One of them is just kind of let's think about the details of what happens when you compound returns. The other is just kind of think about things at a big picture, intuitive level. Let's take the first of those first. Just what happens when you compound returns. Real simple numerical example. Suppose returns are either 10% or negative 10%. Nice round numbers, nice symmetry there. Suppose you get lucky and you draw 10% returns 2 times in a row. 10% compounded for 2 years is not 20%, it's 21%. On the other hand, you might get unlucky. You might draw negative 10% 2 times in a row. But negative 10% compounded for 2 years is not negative 20%. It's not negative 21%. It's negative 19%. All right, simple example, but you can already see the asymmetry. 2 good draws in a row, you're up 21%. 2 bad draws in a row, you're down 19%. That's essentially it. You can have complete symmetry in what happens in the short run, but once you compound things out, you get asymmetry. The longer you let that run, the bigger the asymmetries get. The bigger the degree to which the upside is bigger than the downside. So it comes right out of the mechanics of compounding. But if we backed away from that example, just thought about things kind of intuitively and what do we actually see in the markets? Well, what's the worst you can do on a stock? Negative 100%. Okay, that's bad. And it does happen surprisingly often. That was one of the things that came out of my study. But you're capped on the downside at negative 100%. It's because of limited liability. But you're not capped on the upside. And many stocks do more than 100%. And as I've shown in the series of studies, but not totally a surprise, many people have taken note of this in the past. On the upside, a stock can generate thousands of percent, tens of thousands of percent, or in a few cases, 1,000,000%. So the limited liability, unlimited upside is just another way of seeing that things are asymmetric in the long run in the investment world.
So another interesting finding, I think, is looking at the performance of stocks overall relative to treasuries. And consistently, this is just a pretty wide margin between the performance of these two asset classes. Why do you think there, is this almost continuous, outperformance of stocks over an asset class like treasuries?
To go back to kind of basic economics, we believe people are risk averse. They need to be induced or compensated to get them to take risky investments. At least that's kind of a pillar of economic theory. It is interesting that you can find counterexamples out there in the world. I mean, Las Vegas and casinos in general provide a counterexample. There may be a couple of games of chance where you can tip the odds in your favor, but, they're likely to show you the door if they find you card counting. But those are some counterexamples that are worth thinking about. But in any event, from an economic theory perspective, we believe that there should be inducement to get people into this risky asset class stocks when you could be in low risk alternatives. From an academic perspective, in terms of what's been written in the economics literature, there's a phrase, equity premium puzzle. And that phrase is basically, it's surprising how well stocks do, how big the premium is for the overall stock market. It depends on exactly how you measure it and exactly what period of time, of course, but numbers like 8% per year are thrown around as the equity premium. By some measures, that's a surprisingly large outcome. I might mention, though, I think you used some phrasing along the lines of reliable premium or most of the time premium or something like that. There is ongoing debate about how sure can we be that stocks will outperform low-risk alternatives in the long run. And there was a recent paper in the Financial Analyst Journal by a fellow named Macquarie, I believe. I hope I didn't get his name wrong there, where he brought out some additional historical data and says, the odds that the overall stock market might underperform over, say, a 20-year horizon are a little higher than what some people have argued. In any event, the historical data shows the overall stock market has outperformed treasuries by very handsome margins in the long run, which I think only makes it a little more striking that so many individual stocks don't do so.
So one might look at a study like yours and simply say that they're just going to go out and try and buy the winners. But if only the stock market were so easy. The biggest winners also tend to have gut-wrenching drawdowns. Just to pull one example from one of your studies, you found that Apple, it created more shareholder wealth out of any company from 1981 through 2019, but it also experienced 3 drawdowns of 70% or more. Talk more about some of your findings from this study on drawdowns and what might be a normal drawdown for a high-performing company.
There's no way to say with any degree of certainty what's going to happen in the future, but I have studied pretty big databases of what's happened in the past, and that's something we should pay attention to. So in the study you just alluded to, what I did is I looked at things at the decade horizon, and I basically asked, let's focus on the stocks that turned out to be big winners in a given decade. I focused on the top 100 stocks in terms of enhancing shareholder wealth by decade. And then I just asked, well, what sort of drawdowns did we see? These are stocks that turned out doing really well. How did they do? You mentioned Apple as a striking example of a stock that had some gut-wrenching drawdowns. Amazon, not 3 times, but they had a 90% drawdown. In any event, what I found is that in the study of things at a decade horizon, even within the same decade where these stocks turned out to be big winners, they had drawdowns that averaged 33%. And in the prior decade, the decade before they went on to become big winners, they had drawdowns that averaged 52%. So I know among your viewers, there's quite a few people who do try to engage in stock selection. Just recognize that drawdowns happen and they're frequent. And even for the big winners, it's not unusual to see big drawdowns. So just take into account that that's part of the game.
And when looking at the industry breakdown, many of these top performers are often technology companies, especially nowadays. And that can just make things even more complex for stock pickers. These types of companies, seem to be more difficult to understand, faster changing industries, a lot of potential for disruption that is almost impossible to foresee for many people. And for every tech winner, there tends to be a long list of companies we've never heard of that produced deeply negative returns. To what extent do technology companies dominate this list of top performers?
It's a good question. When you look at one of the lists I created of the top performers in dollar terms, there's a lot of tech companies on that list. As you said, nobody forgets Apple. Nobody forgets Microsoft. Nobody forgets NVIDIA. But what's easier to forget is the dozens of tech stocks that were around for a while and failed. When I dug deeper into it, I actually found that technology stocks were not more likely to end up at the top. As a matter of fact, to a slight extent, tech stocks were more likely to end up among the bottom performers than to end up among the top performers. And I actually found that a couple of other industries, in particular healthcare and pharmaceuticals, as well as energy firms, were somewhat more likely to end up in the top performing lists as compared to their percentage of all the stocks. Now, this wasn't a night and day thing. It's not like any industry is going to reliably provide the stocks that end up at the in the top performing list. But tech stocks were not the most likely, and by a small margin, health and pharmaceutical stocks and energy stocks were actually more likely to end up near the top of the list.
Mm-hmm. The most popular study looked at the performance of individual stocks relative to treasury bills. Mm-hmm. And we find that around 4% of stocks generate all of the net wealth creation. And I believe just under half, around 42%, outperformed 1-month treasuries. Have you looked at any data that instead of comparing to the performance of treasuries, you're looking at some sort of market index like, say, the Dow Jones Industrial Average or S&P 500?
I've never actually compared to those widely recognized indices. And that's in part because the indices themselves have their peculiarities. You're probably familiar that the Dow is something of an odd creature, a price-weighted index. The S&P 500 is more straightforward in being a evaluated index of the biggest stocks, but there's still some discretion in terms of which stocks get included in that index and which don't. It's not purely the highest market capitalization stocks. So I went with something just a little more agnostic, is that I just computed a evaluated portfolio of all the stocks listed on the markets, all the stocks included in the CRISP database. So it's not an index, it's just a evaluated portfolio of all the stocks. And in several of my studies, I also compared to the evaluated portfolio. The effects of skewness are still evident there. The majority of stocks underperform the evaluated portfolio. If it was a purely asymmetric distribution, the average stock would match the average return. But even there, you see it, most stocks underperform their own evaluated average. Just another way skewness presents itself.
Mm-hmm. And I know this might be the million-dollar question a lot of listeners are waiting for. What are some of the characteristics that might help us select, say, a big winner? What are some of the things that are attributed, or what characteristics are found in some of these big winners?
Hey everybody, it's Clay Fink here, host of We Study Billionaires. If you're looking for a network of like-minded value investors to talk stocks, share ideas, and embark on this journey of lifelong learning, I would encourage you to check out our TIP Mastermind community. The TIP Mastermind community has over 100 members and caters to private investors, portfolio managers, and high net worth individuals who are the most passionate fans of the show. In the community, my co-hosts Stig Broderson, Kyle Grieve, and myself host weekly live Zoom calls that we record for the group.
Hey everybody, welcome. Thank you for joining me here.
One of the things I really appreciate about this mastering community is that you meet like-minded people from all over the world, and you have a chance to hang out with them, have a ton of fun, and also talk about investing.
Recent calls I've thoroughly enjoyed are a stock presentation on a recent addition to Kyle's portfolio, and a member spotlight with an investment professional based in London who's compounded his personal portfolio at 37% per year over the past decade. The community really allows us to dive in deeper on topics we typically don't cover on the podcast here. We also have in-person meetups each year in Omaha, New York City, and London. Stig just hosted a lunch and dinner in London with a small group of less than 10 people, making for intimate and personal discussions which are more difficult to get when you attend these larger investment conferences. In October of 2024, we have our meetups in New York City where we'll host 2 dinners in the city and a boat tour to see the beautiful skyline views. And if you're heading to Omaha in May, you can meet up with the community there too, which tends to be our most popular in-person event. I can assure you that I've met many people in the community that I hope to be lifelong friends with, and many members of the group have found similar connections as well. We truly have some amazing members, so if this is of interest to you, I would encourage you not to wait since we're capping the group at 150 members. To learn more, you can join the waitlist at theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind, or simply click the link in the description below. Now, back to the show.
Yeah, so this is what everybody wants to know. And of course, they don't want to know just what are the characteristics that you can observe after the fact. They want to know what predicts. And, we don't have to turn this into a long treatise on market efficiency. The markets are not perfectly efficient. There's a lot of debate about, well, are they close? Are they not close? And I don't have any final answer to that question. There's a big ongoing debate about how efficient the markets are. I don't know if they're efficient, but what I do know is it's competitive out there. There's a lot of smart people looking for the answer to the question you posed. And nothing's going to be easy. If I had told you I did a study and I found this variable that you could find on the firm's accounting statements, and it reliably predicts who's going to be the big winner next year, if that's what I was saying, you should be highly suspicious of that. So anyway, that's not what I'm going to say. It's devilishly hard to predict who's going to be a big winner. But when we look at who is a big winner, we can look and see, do they have something in common? And I don't know if this is surprising or not. I guess it depends on your perspective. But who ends up being a big winner is a remarkably fundamental thing. They're growth stocks, but not in the way that everybody uses the term growth stock. So a lot of people use the word growth stock to mean a stock that has a high market value compared to the book value of its equity or the book value of its assets or something like that, with the reasoning for that terminology being the only reason it has that high market value is that investors are expecting rapid growth. Anyway, that's not how I'm using the phrase growth stock. What I mean is it's stocks that actually grow their fundamentals. So when I looked systematically at the data, and again, this was done at the decade horizon, and said, okay, for the stocks that ended up being big winners in a decade, what can we say about them? Well, on average, they grew their fundamentals. They grew their assets. They grew their cash balance, although my guess is that the causation's going the other direction there. The cash balance grew because things were going so well. But anyway, their assets grew, their cash balance grew. They were unusually profitable, just in terms of, say, income to asset ratio. But most important, and I ran some statistical horse races, most important, net income growth. You know, the proverbial bottom line. Companies that have rapidly growing net income tend to do really well. I don't think that makes it any easier, because predicting which firms are going to have rapid income growth is not an easy thing either. But I do think it helps to focus your thinking. If you can identify stocks that are likely to have rapid income growth, you've identified stocks that have a better than average chance of ending up on that winner list. But anyway, to me, it was striking that to the extent we can find identifiable things in, again, I'm a data guy. I work with the observable data. I work with accounting data from Compustat. I work for prior return data from CRISP. Among the things that I can sink my teeth into as a statistical guy, income growth stands out as explaining what ends up with which stocks end up being the big winners.
It is interesting if, over a really long time period, if a company is increasing their earnings by 25 times, 50 times over a fairly long time period, odds are that's going to deliver pretty strong returns. But say if they double earnings over the next 5 years, there's no guarantee that's going to deliver strong returns if it was already priced as a high growth stock and its PE is 100. Exactly. So, net income growth is certainly an important factor over these long time horizons. And I believe in one of your other interviews, you mentioned lower leverage as one of the things you found. And I would be interested in seeing the data on something like family-run companies. I think companies that have a high degree of family ownership over many years, oftentimes you'll see things like lower leverage. They tend to think longer term, conservative investments, because they view this sort of as a legacy. So I'd be super interested if you've ever looked at any of data related to that.
I've not looked at family-owned companies, but I have a project I'm working on, and I probably won't be able to release it publicly for a little while yet, but it's about CEOs. And I'm naming individual CEOs, or will be naming individual CEOs in the study. So it's people could be sensitive. So it's got to be. I've got to be very, very careful. I've got everything right before I release that publicly. But one thing I have found, and will be in the study when I release it, is the companies with founder CEOs outperform. Not always, of course, but on average, companies with founder CEOs outperform. So. It's not exactly family-owned companies, but somewhat similar. I hope to get that study completed in the next few months and get it released publicly.
And one idea, as I was reviewing your study, I was trying to wrap my mind around was just the length of the study. 1926 to 2022 is a long time period. And I think if you look at any long time period, almost every company eventually falls by the wayside. And I'm also not going to be an investor for the next 100 or 200 years, most likely. I might hold some stocks for, say, 3 years. I might hold some stocks for 10 or 20 years. And since you mentioned net income growth being such a key factor to stock returns, I might see a business, maybe it starts to mature. It starts to see really high levels of competition, just things naturally changed in the marketplace. And then I might decide to exit that company, for example. I'd be curious to get your thoughts on how the findings might change if we looked at a shorter time frame.
I should clarify a little bit. There was this original study that had data through 2016. Then I've had a kind of series of follow-up studies and extensions. I think we'll talk in a minute about where interested people can find those studies. But anyway, in at least some of those studies, I reported things not just for the full sample, the long run, but also at shorter horizons. In these studies, I would have reported on monthly returns, annual returns, decade horizon returns, and then full sample or lifetime within the database, that is. So you can find data on shorter horizons in several of the studies. The general pattern is there. Stock returns have positive skewness, but where it really becomes noticeable is at about the decade horizon. So let me back up just a little bit. Many people will be familiar with the normal distribution, the bell curve. We've actually known for a long time, at least since the 1960s, that stock returns don't conform to the bell curve. In particular, they're so-called fat-tailed. There's too many really big returns. There's too many really small returns as compared to the bell curve. But that said, when you look at things at the monthly horizon, if you just do a plot of stock returns measured over the monthly horizon, it's not real obvious that there's a strong asymmetry. You can kind of see it, but it's not real obvious. Even at the 1 year horizon, it doesn't really jump out at you that there's a strong asymmetry. But once you get to the decade horizon, once you look at returns compounded within a decade, it really does jump out that there's strong asymmetry. So anyway, interested listeners can find some of the results for annual and decade horizon returns in some of the papers. But foreshadowing, it's really at about a decade that this asymmetry really just starts to dominate the outcomes.
I think most people wouldn't be surprised to hear that stock returns in recent years has also shown that asymmetry. So if we look at just data from 2017 to 2019, for example, just 5 companies accounted for 22% of the net wealth creation. So in light of your findings in your more recent studies, do you think, this makes the case for index investing stronger, with things like technology and AI just concentrating into, just these handful of companies?
You're right. The original study showed that there was a lot of concentration in wealth creation, and the follow-up studies have shown that that's becoming even more notable in recent years. Now, does that strengthen the case for index investing or not? There's a tension here, and I've been asked many times, does your study imply that people should be index investors, or more broadly, should you be just broadly diversified buy and hold type investor, or should you be active and should be trying to pick stocks? And what I've said is that I really think that there's some new ammunition here for both sides of that debate. If you were already inclined to think that you should be a diversified buy and hold investor, or that most people should be diversified buy and hold investors, you'd look at my study and you'd say, well, we have all the stuff that's already in the textbooks and already been broadly discussed. Now, on top of that, this asymmetry means that if you just pick a few stocks at random, the odds are stacked against you. You're more likely to lose than win from a few randomly chosen stocks. So anyway, some people, their takeaway is, the evidence is stronger than ever that we should be passive, diversified investors. Other people look at it and say, well, we know the markets aren't perfectly efficient. We know there's at least some opportunities out there. And what this is showing us is how large the payoffs can be if you can successfully exploit your skills or be lucky, to be honest. But if you're either lucky enough or skilled enough to be able to pick the winners, the payoff to doing that's much bigger than we realized it was before. There's some legitimacy to each side of that debate. Now, the fact that the skewness and the concentration, if anything, seems to be growing in recent years, I think it just strengthens the extent to which each side has more ammunition. Whether it actually makes anybody move from one side to the other, somebody who previously thought it's a good idea for investors with the right skills to be stock pickers, whether any of them will switch to be passive investors or vice versa, I doubt it. And I don't know that it's really changed my mind either. It's just the strength of the arguments on each side keep getting stronger.
So if I were to argue maybe why someone should want to index, I would point to the fact that it can just be very costly not to own those top 4% of companies. And if you don't own some of those big winners, then it can just be very, very difficult to outperform. But on the other hand, I think one could also argue that there's still a good proportion of companies more broadly that do outperform. And you don't necessarily have to own, say, the Magnificent Seven to do well as an investor. So maybe own the top 0.1% of these companies. And you've mentioned previously, you're personally a passive investor, and I'm sure many of your students want to enter the world of active investing. So I'm curious if there's what sort of advice you tell them or cautionary advice you tell them to help prevent some of the mistakes that stock pickers tend to make.
I'm mostly a passive investor. I sometimes deviate from that just a little bit, but it's rare, and it's when I perceive what seems to be an unusual opportunity. But it really comes down. It's an economics phrase: comparative advantage. If you haven't been sitting in microeconomics courses, a comparative advantage is actually a really intuitive concept. What are you good at? In particular, what are you better at than the competitors? Some people have the right comparative advantage to be stock pickers or market timers. I'm not sure that that's me. Although, like I said, I have occasionally done some active things. They've seemed to work out well, but it can be hard to tell the difference between luck and skill in a few tries. But it really comes down to comparative advantage, and I would say, dwell on the fact it's not enough to be good. It's not enough to be smart. You have to be better than your competitors. And there's a lot of competition out there. So that's I think, the place that people have to ask. That's where they have to start. They have to ask themselves, do I think I have the comparative advantage to do this? The comparative advantage at buying the stock with the right long-term potential that's not already capitalized into the price, or being able to time my trades. Comparative advantage in being able to live through those drawdowns that are likely to happen, which is kind of in part a psychological question, but also a financial question, to be able to live through drawdowns. So that's the big question. You got to ask yourself, do I have the comparative advantage? For those that do, I say go for it. As a matter of fact, the economy needs you. It would not be good if everybody was a passive, diversified index investor. I mean, Again, I don't know if the stock market's efficient, but to the extent it is, or it's approximately sufficient, it's because active investors are buying undervalued things and selling overvalued things. So if you believe you have the comparative advantage, go for it. The economy needs you, and if you're right, you've got a shot at being rewarded. But here's an analogy that I've brought up a few times. Professional athletics. The payoff, if you have the right comparative advantage, could be huge. But how many people have the right comparative advantage? I mean, I've always enjoyed basketball. I've played basketball recreationally. By a few random events, I ended up in some city leagues playing with some people who had professional contracts but were not in the NBA. This was their off-season thing. And I marveled at how they could be so good, but not be in the NBA. So, to be a successful stock picker, you got to be good, and you got to be better than your competitors. Comparative advantage is the key issue.
One of the things I see, in some of the fund manager letters I read, of course, fund managers have an incentive to say that people shouldn't index, of course. But oftentimes I'll read that they'll point out the increased concentration in the index and point to that as a reason why index funds are riskier today than they were at different periods in the past. Have you ever looked at data and returns at different points where market concentration tends to be higher, and if that, is reflective of what future returns might look like?
So I've never done that in the data, and I think that actually it's a desirable thing to put on the to-do list. I have looked at it in kind of a more conceptual way, though. I have a paper that's called Extending Portfolio Theory to Compound Returns. Maybe this is going to be obvious when I say it, but rebalancing periodically it goes hand in hand with diversification in a sense. So if you started with a well-diversified portfolio, but then you're buy and hold from there, we do have this asymmetry. Some of the stocks are going to do really well, meaning they have a bigger weight in your portfolio. Essentially, that's what we've seen with indices like the S&P 500. The asymmetry is showing up. Some of the stocks have done really well. They've got really heavy weights. Rebalancing by selling those winners and buying some of the stocks that haven't done so well effectively restores your diversification. So to the extent you thought diversification was a good idea in the first place, you might find that trimming your positions in the winners just kind of naturally goes hand in hand with the reasoning about why you diversified in the first place. An index that has a very high weight on 7 stocks is, in some sense, not fully diversified.
Mm-hmm. I think back to many of the conversations I've had on the show, and buying and holding great companies, it can be a big mistake to trim them oftentimes because of just how far they're able to run. And here shortly, I'm going to be mentioning a couple data points from your study, which U.S. stocks generated the highest long-term returns. But before we get to that, has your research and your studies influenced how you've thought about valuation metrics people often use, like price to earnings, price to book, et cetera?
I don't know if it's made any fundamental changes in how I think about them. I mean, they are informative measures. We know that they're particularly important to value investors, try buy stocks that are not at too high a multiple relative to their earnings. In the studies I did of winning stocks, the ones that ended up in the right tail, I did not find that those valuation metrics had any forecast power for who would end up in the right tail. Some people may have been hopeful that would be a big, strong predictor of which stocks end up in the right tail, but I found essentially no forecast power. What I did find is the stocks that did really well in a given decade had high valuation multiples at the end of the decade. But of course, that's totally different than saying those things can predict. It's a competitive market. There's no easy ways to reliably make money. To the extent that those prices relative to underlines reflect that competition, I don't think there's any magic in those ratios, and my thinking really hasn't been altered on that.
Yeah, so I guess my point in the previous question, your most recent study was titled "Which U.S. Stocks Generated the Highest Long-Term Returns?" and the table of top performers is just mind-blowing, to say the least. So the top performer was Altria, and Altria, they compounded at 16.2% from 1925 to 2023. So that amounts to a whopping total return of 265 million %. So tying back to what I was saying earlier with price to earnings or whatnot, someone might have seen a excessively high PE, sometime along the way and said, hey, this stock's too expensive, only to see it continue its massive run. Of course, it's an extreme outlier in this database. One of your other top performers from the study was Vulcan Materials. It compounded at 14% from 1925 to 2023. And that amounted to a total return of 39 million %. And there's a number of names on this list that our listeners would be familiar with. You have Boeing, S&P Global, Coca-Cola, Deere, Hershey, Johnson & Johnson, et cetera. And the most surprising thing to me when I look at this is just the duration at which some companies are able to just keep growing and growing and growing. And it's a reminder to me that if you see a great business that, has the ability to grow, it likely can maybe run much longer than our intuition might expect. So I think our intuition might say, a great company, it's just sort of had its run in the last 10 or 20 years have been great, but how long can they really keep doing it? So that's kind of what I look at and kind of take away looking at it. I'm curious some of your takeaways looking at this list of top performers.
Yeah, so that study has a little bit of a backstory. I think I mentioned that in several of my studies, I had decided to focus on this dollar-based measure, wealth creation, that called it. And at some point in the last few months, Meb Faber, who I think reached out to me and says, some people are asking me about which stocks were the highest, best performers in terms of buy and hold returns. Do you have that handy? And I said, well, sure, I can get, if I have that handy, or I can get that pretty quickly. So I sent him the list. He mentioned it on Twitter. And then I started getting a lot of clarifying questions. So I thought, well, okay, I'm going to get these clarifying questions. I should just write up a short paper that describes how I computed these numbers, where they came from and such. So I did that in a couple of afternoons and released it. And what I maybe didn't completely anticipate is how interested people are in lists of the big winners. So anyway, that's an interesting phenomenon in and of itself. The world wants to know about winners. But the reason I tell the backstory is we got to keep in mind that these are the stocks that, with the benefit of hindsight, ended up at the top of the list. And as we touched on earlier in the podcast, there's thousands and thousands of other stocks whose names we wouldn't recognize who ended up with negative 100% returns. But anyway, so we have to keep that in mind. These are the stocks that ended up being the winners. But anyway, I do think there are some lessons that came out of that study beyond the obvious thing, which is that you want to know these in case it ever comes up on Jeopardy. And you never know. When in a trivia contest, the question's going to come up, what was the highest performing stock all time? Beyond the fact that the trivia can be good to know, some stocks do keep compounding at high rates for long periods of time. Now, many of them won't. There'll be stocks that had really good returns for a year or for 5 years, and then it all falls apart. But it's not impossible. The fact that a stock has had a run-up in and of itself is not a reason to sell it, nor is it a reason to buy it. I mean, it really comes down to fundamentals. The stock's had a big run-up. Does its current price reflect its future potential? Has the current price gone beyond future potential, or is it still under the future potential? I mean, ultimately, it's going to come down to those fundamental questions. I had another study that we haven't touched on yet, where I basically looked at portfolios of stocks that hit certain multiples. Like they hit 5x, or they hit 5x twice to be at 125x, or they did it 3 times to get to 625x. And I just plotted what did the returns look like before and after hitting those multiples on average. And of course, really good returns before hitting the multiple. That's what got it to the multiple. What happens after it hits the multiple, on average, for a portfolio of stocks that hit the multiple, they just track the market on average. On average, a stock that's had a run-up does as well afterwards as a randomly picked stock. It's competitive out there. But anyway, to go back to your question, some stocks maintain this performance for decades. But the study really shines the spotlight on the importance of time in the market. I mean, the very highest stocks in terms of their cumulative returns are stocks that have been there for 70, 80, 90 years. Of course, most of us won't be personally investing for 70, 80, or 90 years, so I also looked at some things over shorter horizons, 1 year, 5 year, 20-year horizons. The really high performers, when you see a stock that's turned in 110% for 3 years, for example, that's not going to persist in the long run. It never has. The stocks that ended up being like Altria or Vulcan Materials, they had good compound returns, 13%, 14%, 16% in that range, but not crazy good compound returns. If you've seen 50 or 80 or 100%, that's great. That's not going to persist in the long run. Just one other thing that I thought was interesting in that list. Now, to be right at the top of that list of highest compound returns, you had to be listed. You had to be on the market for a long time. But there were some pretty, I don't know if ordinary is the right word. There were some stocks that wouldn't describe you. You wouldn't immediately say, well, that's a sexy name. You already mentioned one of them. Second on the list was Vulcan Materials. And, I compiled that, as I said, I compiled that study pretty quickly. I didn't do a lot of research into every stock that was on there. Some of them, of course, we already knew, like, say, Boeing, speaking of drawdowns. But anyway, back to Vulcan Materials. Just shortly after I released that study, the Financial Times did a podcast, some of their own people, talking about stocks on the list. Vulcan Materials is basically a building materials company. We're talking sand and gravel and things like that. But they did a very nice job of pointing out the idea of a competitive moat, which, of course, Warren Buffett likes to focus on, a competitive moat that allows a company to continue to generate good income and growing income. Competitive moats could show up in a lot of different ways, one of which is having access to sand and gravel deposits in good locations because the stuff is too heavy to ship a long way. So having it in nearby proximity to where it's needed is a big competitive advantage. Anyway, that's not exactly sexy or high tech, but nevertheless, Vulcan is number 2 on the list of all-time performers. So I think there's some lessons there as well.
Yeah, you do make a great point about the moat just being so important. If you're looking at a tech company, it's a much sexier industry. It's going to attract, this industry overall is going to attract all these smart people that are able to figure out how to disrupt some of these technology moats. Whereas, there's some other names that a lot of these really smart people aren't really attracted to the industry. So some of these established players can really gain a foothold and just grow at steady rates for long periods of time. And you made another great point that you're certainly right that when you buy a stock, you don't get paid for anything of what they really did in the past. It's all about what they can do in the future, and the future is fundamentally uncertain. And pointing to yet another study you've done, a lot of our listeners are not based in the US and they may invest in different markets. And of course, you've looked at international data. So how does the international data look like the US data in terms of skewness, and how does it differ in any way?
That was in my mind one of the obvious follow-on studies. The original study was focused on the CRISP data, US listed common stocks. It was a natural question to say, is this a global phenomenon, or is it something that's somehow, for some reason, unique to the U.S.? So it took a little longer to do. There's some challenges in building a comprehensive database of global individual stock returns. And I wasn't able to do it for as long a horizon. I was basically able to get a comprehensive sample that covered 30 or a little over 30 years. But anyway, the punchline is when I went to the global sample, it looked just like the U.S. sample. As a matter of fact, in terms of the striking findings that most stocks underperform U.S. treasuries and that the dollar wealth enhancement or wealth creation was concentrated in a few stocks, that was even stronger outside than in the U.S. At this point, I'm not surprised. I think I used this phrase earlier in the podcast. I think this strong skewness is just a fundamental attribute of investing in entrepreneurial economies. People often ask me, well, what do you think is going to happen over the next 10 years, the next 20 years? Of course, there's a lot of things I don't know about what's going to happen over the next 10 years or 20 years. I don't know how the overall market's going to do. I don't know which stocks are going to end up on the winners list. But I feel really, really confident in saying there will be skewness over the next 10 or 20 years. There will be a relatively few stocks that generate the bulk of the performance over the next 10 or 20 years. I think the skewness or asymmetry is fundamental.
Yeah, I guess I would mention, I'll throw an idea out there and you're free to take it wherever you'd like, but I'm not surprised that some of these international markets have more pronounced skewness. Because I would think that just some of these maybe lower quality companies or maybe some of these fraudsters are able to go public in a country like, say, China or India. I'm not sure exactly which country that might apply to, but it seems like the U.S. seems to have stricter regulations about going public. I'm curious to hear your thoughts around that.
I guess I wouldn't jump right to a word like fraudster, but listing standards are definitely relevant here. So one of the findings back in the original paper was that the percentage of stocks that ultimately failed, or more broadly, the degree of skewness in the returns was notably stronger for NASDAQ-listed stocks or companies that were initially listed on NASDAQ as compared to companies that were initially listed on the New York Stock Exchange or on the old MX exchange. What that tells me is that NASDAQ had different listing standards than the more traditional exchanges did. I would hesitate to use the words the wrong listing standards because, in fact, NASDAQ stocks on average, once you take into account that Apple and Microsoft were among them, NASDAQ stocks on average actually did very well. But they had higher rates of failure and more skewness. So they had different listing standards. They were willing to list younger and riskier stocks. I think the same phenomenon shows up internationally.
Mm-hmm. Well, this is great, Hendrik. It's great to bring on a data guy to help us sift through this data and share some of the key findings from doing so. So I really appreciate you joining me here and sharing all this great research you've done. So the final handoff here, please give a a handoff to anyone who wants to read your studies or learn more about some of your work, where you can direct them to.
Sure. So once the papers get published, they're usually behind a publisher's paywall, and that can be a barrier, of course. But before the studies are published, they're posted on a publicly accessible bulletin board called Social Science Research Network, ssrn.com. So all of the papers we've talked about here are posted on ssrn.com. You can just search under my name or do a keyword search. And that includes the published papers. The final pre-publication version is available on SSRN. All that's changed after that is some formatting and occasionally some really minor changes in wording. So anyway, they're all available on ssrn.com, and if you're interested, you can download them, and happy to receive comments.
Wonderful. Well, I'll be sure to get that linked in the show notes for anyone that wants to check it out. There's a lot of interesting stuff in there, and I had a lot of fun sifting through those for this conversation. So Hendrik, thank you for joining me. I really appreciate it.
It's my pleasure. Thanks for having me.
I would spread my bets and invest across the life cycle. Often people think about diversifying, they think about sectors and different sectors. I think about diversifying across a life cycle. I have young companies, mature companies, growing companies, and declining companies in my portfolio, all of which I bought driven by my investment philosophy, which is I want to buy something which trades at less than value. But I also want to get that spread across the life cycle in my portfolio because it gives me cover no matter what happens in the market.